Hello everyone, welcome to my channel hdorionn. We are studying accountancy for class 12 from T.S. Grewal's textbook 2023 edition, Accounting for Partnership Firms, Chapter 4, Admission of a Partner. And in this video, we will discuss preparation of revaluation account and partner's capital account and balance sheet. So let us see some questions related to this. Now let us see question number 68. On 31st March 2019, the balance sheet of A and B, who were sharing profits in the ratio of 3:2, was as follows. Creditors rupees 30,000, investment fluctuation fund of rupees 12,000, general reserve rupees 25,000, capital A rupees 1,60,000, capital B rupees 1,40,000. And to the asset side, we have got cash at bank rupees 20,000, debtors of rupees 85,000, provisions made rupees 5,000. In the outer column, we have 80,000. Stock rupees 1,30,000, investments rupees 60,000, and furniture rupees 77,000. Grand total rupees 3,67,000. On 1st April 2019, they decided to admit C as a new partner for 1/5 share in the profits on the following terms. C brought rupees 1 lakh as his capital and rupees 50,000 as his share of premium for goodwill. Outstanding salaries of rupees 2,000 be provided for. The market value of investments was rupees 50,000. Here market book value is 60,000. Now there is a decrease in value of rupees 10,000, for which investment fluctuation reserve is there of rupees 12,000. So this rupees 12,000 will be used for investment. A debtor whose dues of rupees 18,000 were written off as bad debts paid rupees 12,000 in full settlement. Prepare revaluation account, partners capital accounts, and the balance sheet of the new firm. So solution 68 we will see. First, revaluation account we will prepare. In the second point, it is said that outstanding salary of rupees 2,000 is to be created. So that is increase in liabilities. 2 outstanding salaries of rupees 2,000. And there is a case of bad debts recovered. In point number 4, a debtor who was written off as bad has now paid the money. So for that, it is by bank, because we will receive money. It is 12,000. So there is a gain of rupees 10,000. And it will be given to old partners in their old profit sharing ratio. So to profit on revaluation, to partner A and B in their profit sharing ratio 3:2, 6,000 and 4,000. Now partners capital account by balance brought down. As given in the balance sheet, it is 1,60,000 and rupees 1,40,000. Then profit on revaluation, let us transfer. So revaluation profit of rupees 6,000 and rupees 4,000. Then there is general reserve also given in the balance sheet. General reserve will be distributed in their old profit sharing ratio, that is 3:2. 25,000 in the ratio 3:2 is 15,000 and 10,000. Then investment fluctuation, what's that? Fund, it is fund. This investment fluctuation fund is of rupees 12,000. Out of this 12,000, 10,000 has been utilized because there is a drop in the market value of investment. So remaining 2,000 will be given in their old profit sharing ratio 3:2. So 1,200 and 800. Then the new partner is bringing cash for his portion of capital. It is rupees 1 lakh. Then premium for goodwill brought by the new partner. Premium for goodwill brought is rupees 50,000 and sacrificing ratio is old ratio, that is 3:2. So 30,000 and 20,000. That much only, very simple question, only the basics are here. Fine. Now we will close the capital accounts. So to balance close down. Credit balances we will get. Here grand total is 2,12,200. For B, grand total is 1,74,800. And for C, it is 1 lakh, only the capital brought by him. So this is our capital account. And with these closing balances, we will draft the new balance sheet of the firm. So balance sheet, let us first write on the asset side. There was an opening balance of rupees 20,000 and the new partner brought rupees 1 lakh as his capital and rupees 50,000 as his premium for goodwill and rupees 12,000 is the bad debts recovered. So 1,82,000 is in the bank. Then debtors. Debtors less provisions. Stock is unchanged. Investments decreased by 10,000 rupees. No change in the value of furniture. On the liability side, closing capital balances of the partners. No change in the value of creditors. And a new liability of rupees 2,000 outstanding salaries. So grand total is 5,19,000. So this is how the question is to be solved. Now let us see question number 69. Divya, Yasmin and Fatima are partners in a firm, sharing profits and losses in the ratio of 11:7:2 respectively. The balance sheet of the firm on 31st March 2018 was as follows. Here is the balance sheet given. We have got creditors of rupees 70,000, public deposits of rupees 1,90,000, reserve fund of rupees 90,000, outstanding expenses rupees 10,000, capital of Divya rupees 5,10,000, Yasmin rupees 3 lakh, Fatima rupees 5 lakh. Total capital is 13,10,000. And to the asset side, we have got factory building rupees 7,35,000, plant and machinery of rupees 1,80,000, furniture rupees 2,60,000, stock of rupees 1,45,000, debtors of rupees 1,50,000, and there is a provision of rupees 30,000. In the outer column, it is 1,20,000. Cash at bank rupees 1,59,000. Grand total is 15,99,000. Now further the question says, on 1st April 2018, Aditya is admitted as a partner for 1/5 share in the profits with a capital of rupees 4,50,000 and necessary amount for his share of goodwill on the following terms. Furniture of rupees 2,40,000 were to be taken over by Divya, Yasmin and Fatima equally. So here is a admission of a partner and revalued assets are told here. A creditor of rupees 7,000 not recorded in the books is to be taken into account. Goodwill of the firm is to be valued at 2.5 years purchase of the average profit of last 2 years. The profit of last 3 years were 2015-16 it is 6 lakh, 2017-16 it is 2 lakh and 2017-18 it is 6 lakh. So last 2 years when we are talking, these 2 years are the last 2 years, immediate previous years. This year is the far year and therefore these 2 years. So it is 2 lakh plus 6 lakh, 8 lakh divided by 2, it is 4 lakh. 4 lakh multiplied by 2.5, 10 lakh is the goodwill of the firm. Okay. At the time of Adit's admission, Yasmin also brought in rupees 50,000 as fresh capital. Plant and machinery is revalued to rupees 2 lakh and expenses outstanding were brought down to rupees 9,000. Prepare revaluation account, partners capital accounts and the balance sheet of the newly reconstituted firm. So here machinery is revalued to rupees 2 lakh. So we have to bring this down to 2 lakh. Means bring this up to 2 lakh. It is 1,80,000 plus 20,000 and it is outstanding expenses are brought down to 9,000. So outstanding expenses from 10,000 it will come down to 9,000, decreasing by 1,000 rupees. So let us see the solution. So revaluation account for question number 69. See, in point A it is written furniture of rupees 2,40,000 were taken over by Divya, Yasmin and Fatima equally. So there is no, it is not a case of increase or decrease in the value of furniture. Fine. So we there is nothing to write here in revaluation account. And then creditors are to be recorded. So two creditors. Increase in liabilities is recorded on the debit side. Fine. So it is of how much? 7,000. Then in point E it is written plant and machinery is revalued to rupees 2 lakh. So there is increase in the value of plant and machinery. So increase in asset or decrease in liability we will write here by plant and machinery. From 1,80,000 it has increased to rupees 2 lakh by rupees 20,000. Then outstanding expenses is to be brought down. So decrease in liability. So again outstanding expenses are decreasing from 10,000 to 9,000. So there is a decrease of rupees 1,000. That is all. Now we will see the profit or loss. So there is credit balance. Credit balance is a profit. There is a profit of rupees 14,000 to the old partners. So to profit. It will be transferred to the capital accounts of old partners in their profit sharing ratio, which is 11:7:2. And the partners are Divya, Yasmin and Fatima. So when we break this, we get how much? Rupees 7,700 for the first partner, rupees 4,900 for the second partner and 1,400 for the last partner. Now let us prepare partners capital account. So partners capital account, first we will write by balance brought down as given in the balance sheet. Rupees 5,10,000, rupees 3 lakh and rupees 5 lakh. Then there is reserve fund. So by reserve fund, and in old ratio we will break this, and amount is rupees how much? 90,000, and old ratio is 11:7:2. So when we break it, it is 49,500 and 31,500 and rupees 9,000. Then revaluation profit is also there, as we have calculated 7,700 and 4,900 and rupees 1,400. Okay. Then furniture of rupees 2,40,000 is to be taken over by the old partners in 1:1:1, that is equally. So to furniture rupees 2,08,000 how much? 2,40,000 equally, that is 1:1:1. So 80,000 rupees each. Assets will be given to the partners from the debit side of partners capital account, and all the liabilities to the credit side of partners capital account. Then by bank, because new partner is bringing his portion of capital rupees 4,50,000. At the same time, a partner Yasmin is also bringing 50,000 as additional capital. Okay. Then new partner Aditya is also bringing his portion of premium for goodwill. So by premium. Now premium for goodwill, average profit of last 2 years multiplied by 2.5. So I will calculate it here for your ready reference. It is 2 lakh rupees plus 6 lakh rupees. This is the divided by 2. This is the average profit of last 2 years, that is 4 lakh multiplied by 2.5. It is equal to 10 lakh rupees. This is the amount of goodwill. And now Aditya's goodwill will be how much? Rupees 10 lakh into 1/5, that is equal to 2 lakh. Now this 2 lakh will be given to the partners in their profit sharing ratio, that is 11:7:2. This is their sacrificing ratio also. So in the sacrificing ratio we have to treat the goodwill. So when 2 lakh is divided among the partners, it is 1,10,000 rupees, 70,000 rupees, and rupees 20,000. Now we will close the partner's capital account. To balance close down. Credit balances we will get in all the accounts. 6,77,200 minus 80,000 is 5,97,200. Then for Yasmin it is 4,56,400. 4,56,400 minus 80,000 is 3,76,400. And for Fatima, grand total is 5,30,400 minus 80,000 is rupees 4,50,400. And Aditya it is 4,50,000. So this way the capital account of the partners is ready. Lastly, the balance sheet. First, we will write the liability side. Let us write factory building. Rupees 7,35,000, no change. Then plant and machinery increased by rupees 20,000. So it is 2 lakh now. Furniture is rupees 20,000 remaining, because out of furniture of rupees 2,60,000, worth rupees 2,40,000 is given to the partners. So remaining 20,000 is here. Then after furniture, stock, no change in the value of stock, rupees 1,45,000. Debtors also the same, of rupees 1,50,000, in which there is a provision for bad debts, rupees 30,000. So in the outer column it is 1,20,000. Then finally it is bank. We already had a balance of rupees 1,59,000, and the new partner brought capital of rupees 4,50,000. Yasmin, an old partner, also brought further capital of rupees 50,000, and the new partner also brought his portion of premium for goodwill of rupees 2 lakh. So when you add this, you get a bank balance of rupees 8,59,000, and the grand total is 20,79,000. Now on the liability side, capitals of all the 4 partners: Divya 5,97,200, Yasmin 3,76,400, Fatima 4,50,400, and finally Aditya. New partner Aditya brought capital of rupees 4,50,000, grand total of which is rupees 18,73,000. Then there is public deposit, a liability. Public deposit means the firm has asked the public to deposit their money, and therefore it is a liability. And outstanding expenses also we have, outstanding expenses of rupees 10,000. And creditors were in the books of rupees 70,000, and they are increased by rupees 7,000. So 70 plus 7 is 77,000. Here also the grand total is 20,79,000. So this is how the capital account of the question is to be prepared. I hope that you are watching the full video and listening to the explanation here. Do not miss the explanation part, because it gives you a better understanding of the topic. Now let us see question number 70. A and B are partners in a firm. Net profit of the firm is divided as follows: 1/2 to A, 1/3 to B, and 1/6 carried to a reserve. Okay, so here there is a reserve of rupees 10,000, that is the 1 1/6 of the total profit earned during the year. They admit C as a partner on 1st April 2023, on which date the balance sheet of the firm was. Here is the balance sheet. Capital of A 50,000, of B rupees 40,000. Reserve of rupees 10,000, creditors rupees 20,000, outstanding expenses of rupees 5,000. Grand total is 1,25,000. To the asset side, we have got buildings of rupees 50,000, plant and machinery rupees 30,000, stock rupees 18,000, debtors rupees 22,000, and bank of rupees 5,000. Grand total is 1,25,000. Now coming to the information given below, following are the required adjustments on admission of C. C brings rupees 25,000 towards his capital. C also brings in rupees 5,000 for 1/5 share of goodwill, and stock is undervalued by 10%. It means here the stock is 90%, because if it is 90%, then only it can be said as it is undervalued by 10%. So we will make it 20,000 so that it is justified. Creditors include a liability of rupees 4,000, which has been decided by the court at rupees 3,200. So decrease in the value of creditors by rupees 800. Then in regard to the debtors, the following debts proved bad or doubtful. There is no provision for bad debts here. You see, 2,000 due from X bad to the full extent. So it is a bad debt. 2,000 rupees is a bad debt. Then second, Y, a debtor, 4,000 due from Y, insolvent, state expected to pay only 50%. So again here it is again 2,000 rupees bad. Fine. You are required to prepare revaluation account, partners capital account, and balance sheet of the new firm. So let us see the solution. So solution 70 we will see, and here revaluation account we will assess the reevaluate the assets and liabilities. In point C, stock is undervalued by 10%. Undervalued by 10% means what? What is shown in the balance sheet is 90%, and therefore it is undervalued by 10%. So when 90% is rupees 18,000, how much will be 100%? And we will compare with that. So we will increase. So buy stock. So how will you calculate? 18,000 into 100 divided by 90. It is 20,000. Fine. Actually the value of stock is 20,000, but it is shown in the books at rupees 18,000. So we have to increase the value to normal, that is 20,000. So increasing by rupees 2,000. Then creditors. So by creditors. Creditors are decreasing. A creditor of rupees 4,000 is to be settled for rupees 3,200. So 800 rupees is the decrease in the value of creditors. And from debtors X and Y, there is bad debts. So two debtors, X and Y. X is unable to pay rupees 2,000 and Y is also unable to pay rupees 2,000 out of rupees 4,000. Fine. So 4,000 is a loss, decrease in asset. Now that is all. So 4,000 is the grand total. We get a debit balance of rupees 1,200, and it is a loss. And it will be paid to the partners in their profit sharing ratio. So what is the profit sharing ratio of A is to A and B? A is to B is equal to 1/2 is to 1/3. Forget the reserve. These are the two partners and this is their ratio. So when you simplify this, fine, here the LCM is 6. So 1/2 into 3/3. This is for A. So now it becomes 6. And 1/3 into 2/2. Here also it becomes 6. So when you make the denominators common, that is the LCM, the numerators are the ratio. So the numerator is how much? 3 is to 2. Fine. Here it is, you get 3 and here you get 2. So 3 is to 2 is the profit sharing ratio. So 3 is to 2. When you break it, how much do you get for A and B? It is 720 and 480. So partners capital account by balance brought down. As given in the book, rupees 50,000 and rupees 40,000. And there is a reserve also. Reserve of rupees 10,000 will be paid to old partners in their old profit sharing ratio, that is 3:2. So 10,000 divided as 6,000 and 4,000. Then there is loss on revaluation. $720 and $480. Now the new partner will bring his portion of capital, rupees 25,000, and premium for goodwill also. Premium for goodwill, and it is rupees 5,000, and it will be broken in the ratio, sacrificing ratio, which is old ratio itself, 3:2. So 3,000 and 2,000 for the partners. Now we will add it. 59,000 minus 720 is rupees 58,280. So this is our closing balance, and here it is 46,000 minus 480 is 45,520, and 25,000 for partner C. Now with this closing balances, we will prepare the balance sheet of the new firm. Now the balance sheet. So first we will write on the credits, what's this, asset side, building of rupees 50,000, no change in its value. Plant and machinery also the same, 30,000, no change in the value. Then stock was shown at 90%. Now we are showing it at 100%, that is 20,000 rupees. And debtors are of rupees 22,000, but bad debts are of rupees 4,000, rupees 2,000 from debtor X and rupees 2,000 from debtor Y, 18,000 in the outer column. Then bank, we were having 5,000 as opening balance in the previous balance sheet, plus the new partner has brought rupees 25,000 as his portion of capital and rupees 5,000 as premium for goodwill, which is retained in the business. So total is 35,000. So grand total will be 1,53,000. This is the answer. So asset side has come. Now to the liability side, capitals. Capitals of partner A, B and C. So 58,280, 45,520 and 25,000 rupees. Grand total is 1,28,800. Then creditors. Creditors are shown in the balance sheet at rupees 20,000, but 800 is to be reduced. So remaining is how much? 19,200. And outstanding expenses of rupees 5,000. Same, no change. Grand total here is 1,53,000. So this is how the balance sheet and other important ledgers are to be prepared. I hope you have watched the full video and have understood the concept very well. If you find the video interesting and informative, then please like, subscribe and share this channel. When you do so, I am encouraged to put my best effort for your favor. Please do it so that it reaches the other students who can study from this channel. Thank you so much for watching this video. Thank you so much.